Let's talk about UBO, proof of funds, and proof of wealth. Regulators generally expect financial institutions to identify and verify the ultimate beneficial owners, or UBO, of a legal entity and understand the ownership and control structure behind the business. The purpose is to prevent companies, trusts, nominees, or complex structures being used to hide money laundering, terrorist financing, sanctions evasion, tax crime, or other illicit activity. The regulator standards focus on ensuring that competent authorities and obliged firms can access adequate, accurate, and up-to-date beneficial ownership information. In the UK and EU, firms are also expected to apply a risk-based approach. This means they should not request the same level of information from every customer in every situation. The level of evidence requested should depend on the customer's risk profile, ownership structure, geography, product, transaction activity, source of funds, source of wealth, politically exposed person status, adverse media, sanctions exposure, and complexity. The JMLSG guidance states that firms have discretion in how they apply anti-money laundering and preventing criminal and terrorist financing requirements according to the firm, product, service, transaction, and customer circumstances. Let's understand the difference between proof of funds and proof of wealth. Proof of funds means understanding where the specific money used in the relationship or transaction is coming from. For example, this could be trading revenue, salary, sale of assets, investment proceeds, loan funding, shareholder capital, retained earnings, or proceeds from a property sale. Proof of wealth means understanding how the UBO or customer built their overall wealth over time. For example, this could be business ownership, employment income, inheritance, dividends, sale of a company, investment portfolio growth, property ownership, or other legitimate wealth creation. The regulator explains that source of wealth describes how a customer or beneficial owner acquired their total wealth, while source of funds and source of wealth help firms assess whether the level and type of transaction is consistent with their knowledge of the customer. The regulator also notes that establishing source of wealth and source of funds is specifically required for politically exposed persons. Regulators do not usually say that every UBO must provide bank statements, tax returns, pay slips, inheritance documents, property sale contracts, and full personal financial history in every case. The expectation is more balanced. A firm should understand who owns or controls the business, whether the ownership makes sense, whether the business activity is legitimate, whether the money entering the relationship is consistent with the customer profile, and whether there are any red flags requiring enhanced due diligence. For higher risk customers, complex structures, politically exposed persons, high risk jurisdictions, unusual wealth, cash intensive businesses, crypto exposure, high risk merchants, adverse media, or inconsistent information, the firm should go deeper and obtain stronger supporting evidence. This is where many banks and politically exposed persons move from understanding to document collection. So, when do things go horribly wrong? Banks and PSPs often exceed the regulator intentions. In reality, many payment service providers and banks apply the requirement more rigidly than the regulation itself requires. A low-risk enterprise or small business owners find themselves navigating questions and documents requests that do not match the level of risk they represent. And in majority of cases, these businesses do not have on hand the information or documents they are requested to provide. A newly established business asking for services can find themselves declined or in a very lengthy review process simply because the underwriting team reviewing the application must, according to their policy, tick source of wealth and source of fund box. This creates a gap between what regulators expect and how firms operationalize the requirement. Regulators expect a risk-based, explainable, proportionate, and documented assessment. On the other hand, providers often implement a defensive, checklist-driven, and sometimes repetitive process because they fear regulatory criticism, enforcement action, correspondent banking pressure, card scheme exposure, fraud losses, sanctions breaches, and reputational damage. So why providers overcollect information? Banks and PSPs often overcollect UBO proof of funds and proof of wealth because the cost of getting it wrong is high. If they onboard the wrong customer, they may face regulatory findings, financial crime breaches, sanctions exposure, fraud losses, chargebacks, reputational harm, or partner bank pressure. For PSPs, the pressure is even stronger because they are often dependent on sponsor banks, acquiring banks, card schemes, correspondent banks, and technology partners. This means the provider may be asking itself, can we defend this onboarding decision if a regulator, bank partner, card scheme, or auditor reviews the file later? As a result, the provider may ask for more evidence than the customer expects, even where the customer feels the request is unnecessary or intrusive. This has a major impact on the customer journey. For business customers, especially merchants, fintechs, crypto businesses, cross border companies, high risk verticals, newly established businesses, and businesses with complex ownership structures, onboarding can become slow, repetitive, and frustrating. Customers often experience repeated document requests, unclear explanations of why documents are needed, different teams asking for the same information, requests that do not appear relevant to the business model, long silence between review stages, last minute escalation to compliance or underwriting, requests for personal wealth information from UBO who are not involved in daily operations, applications being declined after weeks or months of effort. The result is a poor onboarding experience. The customer feels they are being treated as suspicious before the provider has properly understood the business. The impact on growth and retention for banks and PSPs, excessive or poorly managed UBO proof of funds and proof of wealth requests can directly damage growth. It can reduce conversion because customers abandon the onboarding process. It can increase acquisition costs because sales teams spend more time chasing documents than closing accounts. It can damage the brand because merchants share negative experiences with other businesses. It can also reduce retention because existing customers become frustrated during periodic reviews, account reviews, volume increases, or additional product applications. For the customer, it creates commercial harm as well. A delayed onboarding process can mean lost sales, inability to accept card payments, delayed market launch, interrupted settlement, inability to open banking relationships, or being forced to use more expensive providers. In simple terms, badly managed compliance becomes a business blocker. So, what good practice should look like? A better approach is not to ignore UBO proof of funds or proof of wealth. These checks are important. The better approach is to make them risk based, clear, and commercially intelligent. Banks and PSPs should explain why the information is required. Request only what is proportionate to the risk. Avoid asking for the same document multiple times. Separate proof of funds from proof of wealth clearly. Accept reasonable alternative evidence where appropriate. Use public registers and independent data before asking the customer. Train onboarding teams to understand business models, not just collect documents. Escalate complex cases to skilled analysts earlier. Give customers a clear document checklist at the start. Avoid account closures or delays caused by vague information requests. For merchants and applicants, the best approach is to prepare a clear UBO and funding pack before applying. At CRAC.SOLUTIONS, we can support you with that and challenge providers when their requirements exceed the level of risk you and your business represent. The commercial conclusion is simple and logic. The regulatory requirement is not simply collect proof of funds and proof of wealth from every UBO. The real requirement is to understand ownership, control, legitimacy, risk, and whether the customer's funds and wealth are consistent with the customer profile. However, many banks and PSPs apply this through rigid document collection, often without explaining the logic to the customer. That creates friction, delays, abandonment, rejection, and poor customer retention. The providers that win customers are not the ones that ignore compliance. They are the ones that make compliance clear, proportionate, fast, and understandable. That is where customer growth and regulatory control can work together instead of against each other. If you or your business find themselves in a situation that seems unfair or you feel does not match your business, we recommend contacting us with the details, and it is more than likely we will be able to resolve the situation that you are in quickly and effectively. We might also be able to match you with other providers, ensure your risk levels are set correctly, and negotiate better pricing. Thank you for listening and speak soon.